Sam Seder on the Majority Report on the phone. It's a pleasure to welcome to the program Assistant History Professor from UC Berkeley and author of Accounting for Slavery, Caitlin Rosenthal. Welcome to the program, Caitlin.
It's great to be here. Thanks for having me.
So, okay, now this is there are some business terms in here, and you at one point, my understanding is, were a McKinsey consultant, and have written on that aspect of business practices. So let's just start. Well, how did you come to write about this? And then I want to just make clear a couple of terms that, if we were all consumers of business theory, we would know off the bat. But tell us first how you came to write about this topic.
Sure. Right out of college, I worked as a consultant for McKinsey & Company, and when you're the most junior person on a team there, you're the person who gets the spreadsheet, and you spend a lot of time crunching the numbers to figure out how you can help companies be more profitable. And so I spend a lot of time analyzing data about people who I never met and people who I was never going to get to meet. And the decisions that I was helping people make nonetheless had a big impact on their lives. So I went back to graduate school interested in the history of how data developed over time and how data changed the way people thought about businesses as they got really big. And when I got to graduate school, I first started studying the history of northern textile mills because that was where I assumed the story would be. Kind of from my undergraduate history education, it was all about iron forges and textile mills. And then I quickly realized that the biggest businesses of the early 19th century are actually slave plantations in the West Indies and in the American South. So I started to look at their records and was really surprised to discover that some of them collected as much or more data as the factory counterparts that I had assumed would be the center of the story.
And so it is that. And so, all right. So let's, with that stated, that there is this sort of almost in some ways a lost history of this of these business practices. Talk about. Let's, I guess, introduce it this way to a certain extent. There's a theory or a narrative, anyways, of mutual progress that in some way slavery was a hindrance to capitalism, and that as capitalism grew and these type of business practices grew, it was sort of emancipating in some respect. But it really turns out to be not the case.
Yeah, that's kind of the narrative I found to be prominent as a consultant. Just a kind of an assumption that creativity and innovation go together with advancing freedom. You know, that the coming of capitalism is all about free labor. And what I find is something pretty different, which is that the North and the South were advancing together. And this is in some ways something historians have known for a long time, but there haven't really been business histories. So we haven't seen how these practices have unfolded in a business setting. There's a management scholar who actually described this as the denial of slavery in management studies, because he said if you go read even histories of the South, you don't even have to go back to the archival records, which is what I did, but to begin to understand how advanced and sophisticated some of these plantations were. And this scholar, Bill Cook, argues that this is kind of so easy to find that it counts as denial. So what I did was to go back into the records themselves and ask how they compared to the management milestones that we usually associate with the rise of American business. So the book is not about like the average slaveholder. It's about the people who would have been in our business histories already, the kind of Carnegies and Rockefellers of American slavery, who, but for the terrible and brutal nature of their business, would probably already be part of our national story because they were so innovative.
And in fact, their innovations were far more prominent and durable than we commonly understand.
Yeah, so they're using, I structured the book around the big milestones of modern business history, which include things like what people call the M-form corporation, but it's basically like a modern organizational hierarchy, and also the accounting innovation of depreciation. Those are things that both were appearing on plantations relatively early. And in the case of depreciation, you have only the most innovative corporations using depreciation until the late 19th century, and planters are using it to depreciate people from the 1950s, not the 1950s, the 1850s.
Okay, yeah, now we're getting into the sort of the terms, and as we talk about these milestones in business histories, this is where I think we're going to need some, or I certainly am going to need some extra help. So when we talk about, let's start with first the idea of depreciation. How is that used in well, and I don't think it's changed really in business parlance in a couple hundred years, maybe, or at least 150 years. But explain to us what depreciation is, so that we can appreciate, no pun intended, what it means in this context.
Certainly. So depreciation is when you have a big fixed cost, I'll just give you the example of the railroads, because that's what the canonical example usually is. So a railroad and railroad tracks and locomotives cost a huge amount of money. And you make that investment usually all at once. But as you're calculating your profitability, you want to figure out how to spread that investment out over time. And wear and tear means it's going to decline in value. So you take your train and you say it's worth this much today, and then you figure out how to value it over time, which has implications both for your profits, and then today it has big tax implications. So that was less so at the time. So it's a strategy for figuring out the changing value of long-lived capital assets. As Alfred Chandler, a famous business historian, calls them, he says, complex, long-lived capital assets are the origination of depreciation. And so on plantations, I mean, the most complex and long-lived of capital assets is a person. And people are unique because, unlike most factories and machines, people are unique for lots of ways, I mean, which we could talk about in a minute, but enslaved people appreciated in value as they grew older, as they learned skills, as planters invested in what we would call human capital. Then their value peaked in their late teens and 20s, and then already into their 30s, people are beginning to depreciate and decline in value as they get older.
And so what does this tell us about the way that, so what does that tell us, that these depreciation, this depreciation perspective was applied to human beings? Because we don't see that in modern day worker, or even in contemporary workers who were actually paid, right, and had the freedom to leave. Did we?
So this is like a yes and no. Of course, we don't depreciate people in the way that planters did, in that same kind of reductive way that assumes you have power over someone. But of course, human capital is a huge part of the ways businesses think about strategy. And planters didn't call it human capital, but they clearly do calculations of human capital, and they assess how they're changing over time to make business decisions and to figure out kind of how to allocate the people who are the capital that's the basis of their business.
Okay, will you explain that term to us too, human capital? I mean, what do we mean by that in business parlance? And then how is that used in the context, or not used, but I guess assessed in the context of slavery? Because it seems to me that on some level, the whole key to slavery from the perspective of the plantation owners is that this is not human capital. This is more or less, these people, our slaves, are more or less like the things that till the land or something. They're machinery.
So when we talk about human capital, we talk usually about investments in skills, like businesses might train someone to increase their human capital, and plantations are interesting because you see the exact same thing. I have ledgers from the British West Indies that have something like 20 different occupational categories, many of which are skilled, like a skilled blacksmith or a skilled cooper who made barrels. And even within those skilled categories, you have enslaved people who are the head person within that category, so they're also in charge of being managers. Now, today businesses worry about losing their human capital, and planters didn't have to worry about people quitting. They had to worry about people running away, escaping from the plantation. They had to worry about death, but they have many of their problems really radically simplified. But to get to your other point, what's interesting is that planters are at the one treating people as skilled labor, but at the same time, the record I just described that has those 20 occupational categories is immediately followed by an identical record for livestock. That instead of the categories of labor, you have sheep and mules and categories of so people are being treated really as animals and machines, but also planters understand that what makes them so valuable is the fact that these are people. So they're able to do both kinds of accounting and move back and forth between them.
And so when we talk about the way that they treated human capital, I guess, and also this concept of depreciation with the workers as if they're a piece of equipment they bought. I mean, where does this how does this implicate? I mean, were these like founding these practices? Do they end up becoming like the building blocks of modern day capitalism and I guess business practices?
So the story I tell is not exactly an origin story. When I first started writing the book, I didn't really understand what a big deal slavery was. I mean, it sort of sounds silly to say that, but I only slowly began to understand how foundational it was to the American economy. So when I first started writing, I was looking for, the single link that was going to show that plantation slavery influenced Northern scientific management. And I did find some links, but not really a smoking gun that said this is the foundation. What I uncovered instead is the fact that the Northern and Southern economies and also the Northern and the Caribbean economies are just deeply intertwined for the whole 150 years where capitalism is emerging. So I came to think it was sort of, I was asking the question wrong if I was looking for the single link, because really what you have is two economies that are intertwined. All those textile mills that I thought the story was going to begin in are, of course, weaving slave-grown cotton. And these people are in communication all the time. So it's not really about one link. It's really about the whole story being more complicated. And
and I think there's been a lot of, we've interviewed over the past couple of years several historians who have gone back and sort of reassessed the import of cotton, frankly, and I guess maybe other, tobacco, but primarily cotton in terms of driving the economy, not just of the South, but of the North as well. And so was there a sharing of back and forth in terms of business practices? I mean, the gist of it is just that really how sophisticated these big plantations were run, which I guess is a surprise because why?
Well, so it's an interesting question. How surprising is this? When I was a consultant, I used to joke that insights needed to be surprising or resolve controversy. And the interesting thing about this fact is that people either find it super surprising, like they had no idea because they really believed that slavery was backwards from the perspective of innovation, or they find it totally unsurprising. They're like, I never thought about business practices, but of course, knowing what I know about slavery, So it's a kind of it's like a litmus test for where we are in our national conversations about slavery, which is that some people have begun to get it, and they start to read about plantation business practices, and it's still really tells them a lot to see the granularity of how they innovated with violence. But the most illuminating thing is that a whole other set of people find this stuff totally shocking.
Right.
The idea that planters were using basically paper spreadsheets to calculate the output per person in a very similar way to what we do now.
So the shocking part is that there is some type of presumption that exists among some people that slavery was somehow an aberration in some way, and that it was a function of the people who would have slaves were not business people. They were just, there was something anomalous, I guess, about it. But in fact, it's really part of a tradition and almost in some respects sort of seamlessly slides into an era where people aren't slaves, right? I mean, like how much of our business practices that we have today in terms of management techniques and control of workers is, if not a descendant of those practices, but at very least, looks very similar to those practices?
So, I mean, a huge proportion. Like if the book talks about the standardization of forms. It talks about the way we developed our hierarchies. It talks about this question of depreciation, which is linked to the whole question of human capital. And it also discusses productivity analysis. I mean, you'd be hard-pressed to find another big area where data science and accounting have kind of are totally different. So those are, I mean, four of the main innovations, and the plantation is there for all of them. Now, you're right to say that the plantation isn't necessarily the foundation, but it's the part of the environment from which these practices emerged. And there are all kinds of things that just look strikingly similar. So if we go back to the topic of depreciation, there's two ways that people generally talk about depreciation: a straight line depreciation and a mark-to-market depreciation. These were chatted a lot about during the mortgage crisis because which way you chose had implications for how valuable people thought things were. Straight line is just that you depreciate the same amount every year. So you say, I have something that's worth $20, and you just reduce it $1 every year. Mark-to-market says each year you look to see what the market value is, and you change that market. So there's a planter named James Green Carson who, for all of his slaves, he has a formula, and he values enslaved people from age 0 to 10 with a straight line, doing straight line appreciation. They increase by $50 the first year of life, because if you survive the first year, you're likely to survive longer, than $25 for each additional year. But then when he gets to 10, he says, look, the diversity of these people means that values diverge. And so he starts marking them to the market value, which changes over time and can go up and down from year to year.
The market value depending on what skills they have. Maybe the blacksmith
on what skills they have, but
go ahead.
So what skills they have, but also how the market prices are changing, because the value of slaves over most of the antebellum period is going up. So the value of slaves in 1960 is a high value. They've proven a very good investment for people, both because of the labor that they're extracting, but also because the market value of slaves has gone up.
Now, depreciation at that time, there was not a function. It wasn't something you did because of taxes. It was because to determine just what are my profits and what are my assets, right? At that time, as a plantation owner.
Exactly. You have the planters I've seen calculating depreciation want to know how much money they're making from year to year, and not all of that is coming in cash. A lot of it's coming in the form of their investments. So they calculate the value of those investments over time. There's a famous, not that famous, but a relatively well-known quote from Thomas Jefferson where he suggests that people should invest as much as they can in slaves, because in addition to the labor that they give you, they also appreciate about, I think he says 5% from year to year. So you get both the labor and a capital increase.
And I guess
you also might be doing this to show to a bank. The bank, you can get a loan collateralized by slaves, so you might be taking this to show to a bank.
I know that's not. I know that's scholarship that has been done that pre-existed, but tease that out for us, because this is. I guess theoretically, as I sit here and talk into this microphone, I bought this microphone 5, 6, 7 years ago, or 8 years ago. Let's say it cost $400. If I needed to get a loan and wanted collateral, I don't know how much I could get based on this microphone, but this microphone would function as collateral, or the video camera, or the computers. Theoretically, I guess they wouldn't have that much value, but. So this is another difference between...
it's exactly the same thing, but enslaved people were super valuable, and they could be moved from place to place and used to collateralize loans to buy more land and to buy more people.
And so their value to a plantation owner was not just in the work that they produced, but the potential work they could produce, or value they could produce.
Absolutely. Some of the most horrifying records from plantations are like slave trade, not from plantations, from slave traders, have values for a woman with her first child. And a woman with her first child was especially valuable not only because of the child, but because this is a woman who is fertile. She's going to reproduce again. This is a woman who's going to survive childbirth because she survived it before. So she's being valued based on her own potential labor, but also on her potential reproductive labor and the labor of the children who are going to be enslaved as well. So planters are forward-looking, thinking about how assets are going to grow over time.